Hey, what's up, everybody? It is Monday, April 11th. Let me keep those on. Ugly day today. We're back to the ugly Mondays when the market has a sell-off, and it really accelerated towards the end of the day. Kind of disappointing. I guess not if you're short. And we've given back now about half of the March, from the March low to the peak in the S&P, that rally. We've given back about half of that. I suspect today sell stops were hit. I had in the S&P futures, in the June S&P futures, underneath 44.15. I was anticipating that sell stops would be hit, and we just got down there basically by the close. So I guess tomorrow morning or tonight we could have some more selling. So, like, everybody knows what's going on. It's very obvious. We have interest rate, bond yields going up because the Fed is expected to policy shift aggressively hawkish. If you look at Fed fund futures, they're now pricing in 6 rate hikes through the end of December. The first 3 hikes, we're talking about May, June, and July, 50 basis points each. And then September, November, December, if I have those months correctly, 25 basis points each. So that should put the funds rate, the policy rate, up to about 2.5% by the end of the year. And that's basically, where bond yields are, a little bit higher, so they're pricing in a little bit more of a hawkish position by the Fed. So that's baked in. I mean, as far as I could see, that's already priced into the market. I said we were going to have this kind of choppy, erratic trading leading up to the May 4th Fed meeting. I do not expect, let me say this, I do not anticipate the February 25th lows to be taken out. Remember, we had a low, like a spike low, and then a bounce up in February 25th. Then we had I think it was March 8th and maybe March 14th. Those were 2 other times that we tested near the low, not that February 25th low, but we tested near the low the 2 times. So, but look, I mean, it's not like I can't understand why people are selling. I mean, they're saying the inflation environment, the rates environment, the war. What am I leaving out? Now let's talk a little bit about some of this stuff, because like right now, oil prices have come back down to the pre-Russian invasion level. I mean, I think we hit like 92 something today in WTI. We settled around 94. So that was down 5% or 4 or 5% today. So the entire Russian invasion spike has been taken back. We've seen the last 2 weeks gasoline prices at the pump coming down. Other commodity markets like lumber now, it's given back about almost 40% from the highs in early March. Copper's down a little bit, wheat's down a little bit. So I mean, we're seeing some, at least you can call it a pause in the inflation impetus, a commodity spike, whatever you want to call it. We're seeing somewhat of a pause in that. But bond yields keep going up, and that's, the Fed. Everything you hear about the Fed, and this is a key thing, because, the market is very much and very often driven by sentiment and commentary. And like everything is like the Fed is way behind the curve. They're panicking. If they were panicking, I think we would have seen an intra-meeting rate hike. We didn't see anything like that. All right, or an inter-meeting rate hike. We didn't see any rate hike in April. There's no well, so far April just began, but there's no meeting this month. They're meeting next month. So, and they're going to go 50 basis points for the next 3 months. And again, I say that's completely priced in. And keep an eye on what's happening with oil, because that has been a key factor and a key driver. Food prices too, of course, but oil. The big spike in oil, the Russian thing, the war, again, oil prices are where they were prior to the Russian invasion of Ukraine. We have also seen, or I've seen, I think I mentioned it, that U.S. oil production now is at the highest level in 4 months. We're back up to 11.8 million barrels a day. All right, the last 2 weeks we saw 100,000 barrel a day increase in output. I mean, it was static for over 2 months. I mean, we were stuck at 11.6 million barrels a day for over 2 months. It really, during the entire time that we had to lead up to the war, and even when the war started, that U.S. domestic oil production was just stuck. But now it seems to be moving up again. We've seen some, I think I mentioned, we've seen some pullback in gasoline demand. So that's a mitigating factor, I think, price-wise. And again, we're starting to see that at the pump. We're starting to see some price declines at the pump on the retail level. What else is going on? That's about it, really. I mean, we have a very negative market psychology right now, a very negative psychological environment. I mean, everything looks terrible. You got the war, you have inflation, you have fears over monetary policy, including not just rate hikes, but the Fed shrinking its balance sheet. And I've been talking about that now for the last several videos. And again, not to sound repetitive, but I'm looking forward to getting this whole thing going. I can't wait until May 4th and until they actually start reducing their balance sheet, and let's see how that plays out. I've been saying that I think the vast majority of people, and the way the markets are responding to this, and the way they react every time there is a comment or a discussion of monetary policy and what the Fed is about to embark on, I just say that's the wrong reaction. It's a reaction based on a lack of understanding. But we'll see how it plays out. So today I was doing some light buying on the way down. Actually, if you're a chartist and if you look at this kind of pattern that the market is tracing out, if you look at the S&P or if you look at the NASDAQ, it almost looks like a reverse head and shoulders, if you're into that kind of stuff. I mean, you had the one dip, which is the left shoulder, which happened earlier this year. Then you had the head in February. And, then we rallied up, and it looks like we're making the right shoulder now with a very, very defined neckline. So that ought to be interesting, because you got, people who follow the charts and who are technically oriented, who might look at these patterns. If we hold at these levels and it starts going up, then I suspect you're going to be hearing more, at least from the chartists, about a reverse head and shoulders, which is a bullish pattern. Keep an eye on that. Follow that. But we need to hold at these levels. And I think today and maybe tomorrow, we're going to see those sell stops get hit. We started to see these today. I think that was the acceleration near the end of the day. And once they get flushed out, I think we start to turn around again. Fiscal is good. We're trending towards like a 575 billion month. That's very solid. I mean, there's nothing to complain about with just barely almost making 600 billion again. we're doing right now about so far this month in April, which is basically what, six business days. We're at about 220 billion. That's tracking equally what we saw in March. So fiscal is fine. The bank data, again, very strong with loans. I think I mentioned that on Friday. Very, very strong with loans. Banks were buying treasuries aggressively. I would say the only thing negative in the bank data was the losses on available for sale securities. You know, banks on their fixed income holdings, obviously with bonds crashing and yields going up, they got record unrealized losses, and that is really what is impacting bank stocks in a negative way. I mean, residual, which is capital, that we had a nice bump up in the latest week ending March 30th, but those losses, unrealized losses on securities, you know, that's a drag, obviously. So that's it for today, folks. Another crappy Monday. Got selling going. That's been the pattern. I mean, the only time we didn't see that was last week. We actually had a decent Monday. I think I mentioned it or I wrote about it. But we're back to Monday selling. Let's hope we go to the turnaround Tuesdays. That's it for today, folks. Enjoy. See you tomorrow. Bye.